And studying interest rates is important for many reasons. The first reason is that it's an indicator of the interplay between government and the economy. You need to know that interest rates as they exist today are fake. They're manipulated by the government. They're not set by a free exchange between buyers and sellers. When you have a government like the US government, or the Canadian government for that matter, that is trying to artificially depress interest rates, which the US government is actively trying to do, and they can't do it, it's telling you something. It's telling you that inflationary expectations in the private market is overcompensating, or is compensating at least for the efforts to artificially lower interest rates, which is to say that the market is beginning to assert control over the long term, over the price of capital, expressed as policy preferences, are usually either exaggerations or lies, and I expect this one to be no exception. The statement by the Chinese that they were banning the exports leaves open the possibility of exports through official channels. In other words, if you are a private sector entity that's affiliated with the Chinese state, you get an export license. If you aren't, you don't. This is a form of rent seeking, the passing out of favors, that's as old as government itself. And I don't expect that this will really impact the free flow of silver into and out of China. It will just control who gets paid for it. Remember, Jesse, the true definition of an election from H.L. Mencken was that they're advanced auctions of stolen property. They conduct those auctions differently in China, that's all.
Yeah, very well said. I want to dive a little bit into your methodology for evaluating
$45 an ounce, and would make very, very, very little difference in their silver output, or frankly, in the free cash flow from the copper mine. A silver miner, a pure silver miner, has a very different experience. So you absolutely, positively, to exist in the silver market in the long term, need to be in the bottom quartile in terms of all-in sustaining costs, and you also need to be in the top quartile in return on capital employed, which is to say, efficiency is everything. Now, that's a difficult discipline to impose on yourself, because in rising silver markets, the least efficient producers generate the best margin gains. Think about it. If you are let's say that you're selling silver in today's market for 85 cents, $85 an ounce.
You just heard some truly eye-opening perspectives on the state of precious metals. Rick Rule, the billionaire resource investor and Sprott alumnus, is known for his deep dives into mining stocks. He believes that while physical silver has its place, the real speculative upside right now lies in silver equities, even with recent volatility. Rule points out that silver stocks were recently discounting a much higher silver price than we're seeing today, a clear sign of potential. He also shared his own significant holdings, noting his substantial physical gold and speculative silver stock positions. Now, as we move into the second half, get ready for an even deeper look at what's driving these seismic shifts.
By the way, it's no different to what Trudeau did to the Canadian economy, or to what Trump is doing to the American economy. I'm an old cynic now, but I suspect that that phrase, "you can tell politicians are lying when their lips are moving," applies to Mr. Modi today. Why on earth would anybody trust him? Why on earth would anybody heed his admonition to buy a financial product, bonds, which he's printing like mad, and ignore a commodity which has protected Indian citizens from their government for 1,000 years? You know, Jesse, this brings up an interesting circumstance. One of the fastest growing parts of my database, unlike the last 40 years, has been young Indian female expats. Adherence to gold with disposable income. I understand now why, but about 3 years in bribes to get that gold into India. To the extent that the excise tax goes up, all of that is our margin. Now, what is the probability that a civilization conditioned by 1,000 years of disrespect for government, where the borders are porous enough that exchange can be evaded for 2.5%, and where counterfeiting, literally counterfeiting, where the excess production by the government of their own currency and their own bonds is increasing at a breakneck pace. What are the probabilities that the Indian citizenry are going to pay attention to this guy? I would suggest to you, Jesse, that the probability of that is nil.
I want to talk about the gold mining sector now. The same pattern as with silver is taking shape when we look at the gold miners using the GDX ETF as a proxy, barely outperforming gold itself this year. This is despite record earnings being reported by the big producers such as Dumont.
Jesse, at some point in time, I'm 73 years of age. At some point in time, I'm going to stop buying this stuff and start selling it. And I'm delighted that the market that I'm going to sell to will have to buy from me because they haven't bought before me. I'm absolutely delighted with that. I need to say, we will need someone to sell to. And I can see who those someones are without too much focus. I believe, and I may be wrong, by the way, but I believe, and I've told you before, and I've told you too, the oil industry has been underinvesting between $1 billion and $2 billion a day in sustaining capital. That just got worse. None of Iran, the UAE, Kuwait, or Saudi is investing a lot right now in sustaining capital investment because they're using the money for other things, killing each other. In addition to that, the oil industry needs to replace or repair all the facilities destroyed by war. What this means is that in 2029 or 2030, irrespective of the outcome in the Gulf, that oil, at least production, will be in shorter supply. Because if you don't make sustaining capital investments, you impede your ability to produce. Now, your entry point could be a problem in the near term. If peace breaks out in the Gulf, and I dearly hope it does, those cargoes which are stranded north of the Gulf that replenish world markets likely bring down the price of oil. Should another thing happen, which I hope does, should peace break out in the dispute between the Russia and the Ukraine, it would over time unleash the flow of Russian oil into world markets. That flow will be constrained because the Russians haven't been making sustaining capital investments either. They've needed the money to maintain the domestic economy in the face of war. But over time, that would increase supply. But no matter what we do, the lack of sustaining capital investment and new project investment in the oil and gas market means that in the period 2029-2030, that's going to be a very, very, very good place to be.
I believe is very bullish. But we have seen a whipsaw in volatility, up double digits, down double digits the next day. What do you think is causing this volatility in the sector? And what are your overall thoughts at uranium at present? Do you think there's still value there when it comes to the miners?
Last question first, yes. The biggest economic beneficiary of the Gulf conflict will be uranium. It's worthy to note that the French nuclear fleet, the fourth largest in the world, the Japanese nuclear fleet, the third largest in the world, were constructed largely in response to the Arab oil embargo of 1973. That event refocused nations who were not energy self-sufficient on the need for a fuel that was dense enough that it could be stored domestically to fuel domestic industry. Japan noted pointedly that they could store enough uranium in one warehouse to power Japan for 5 years. They obviously couldn't store that much oil that much.
Rick Rule just laid out a stark reality for silver stocks, saying they're still discounting prices that seem like a distant dream. He's been in Pan American Silver since it was pennies on the dollar, and he believes those stocks still offer a better speculative ride than holding the metal itself. But here's the thing, even as he talks stocks, the underlying pressure on physical silver is building. We've heard about draining vaults and dealer waitlists, signals that supply is getting truly scarce. What happens when the buyer of last resort stops showing up or can't find the metal? This isn't just about market timing anymore. It's about protecting your wealth from what looks like an impending, fast, violent, and irreversible economic reset. When you hear about the biggest bubble in human history potentially popping and the end of the petrodollar looming, the question becomes less about times, if times you should act, and more about how quickly. So the real question is, do you want to be the person who understood this early or the one who explains it to their accountant later?